Good morning, everybody, and thanks for tuning in. My name is Johannes Stroebel, and I'm a professor of finance at the New York University Stern School of Business. And today I want to talk to you a little bit about some research that I've been doing studying the right discount rates for a climate finance project. The motivation is sort of pretty straightforward for this research agenda. It's that we have many proposals today, by the Biden administration, by Governor Cuomo in New York and other policymakers to invest substantial amounts of money in various projects that allow governments to reduce and mitigate the effects of climate change. And when trying to figure out which of these projects are desirable to invest in, which of these projects are profitable, what's going to be really important is to do a cost-benefit analysis. Now, because a lot of the benefits of climate change mitigation projects, accrue potentially decades in the future, what's going to be really central in terms of valuing these projects is the discount rates that you apply to these benefits that might occur over these longer horizons. And this is not new. So Bill Nordhaus, the Nobel Prize winner, rightly pointed out that any consideration of the cost of meeting climate objectives requires confronting the thorniest issue of all climate change economics. How do we compare present value and future costs and benefits? Appreciation of the economics of climate change cannot proceed without dealing with discounting. Now, in practice, this is very, very difficult. And so the Office of Management and Budget, for example, recommends using a wide range of discount rates, anywhere from 1% to 7%. And the reason for this, and this is again quoting directly from a circular, is that private markets rate provide a reliable reference for determining these discount rates within a generation. But for extremely long time periods, and these are specifically the time periods that we're thinking about in climate change, no comparable private rates exist. Now, it's not going to be no surprise to anyone that whether or not you use a 1% discount rate or a 7% discount rate has a huge effect on the present value of these benefits occurring, even at medium range horizons. So what I'm showing you here is the present value of a dollar, say, accruing 25 years from now. That's where the dots are. And, valuing that dollar at a 1% discount rate, a 4% discount rate, and a 7% discount rate. And you can see that at a 1% discount rate, that dollar accruing 25 years into the future is worth about 80 cents today. At a 7% discount rate, it's worth less than 20 cents today. So which of these ends of the range you end up in is going to be absolutely central to figuring out whether or not a specific project is valuable or not. And so here's where some of the research that I've been doing has come in. So this is work together with Matteo Maggiore and Stefano Giglio, where we're trying to fill this gap that the OMB circular, lamented, that there isn't really sort of any information from private markets about how you want to discount or trade off, say, having a dollar today versus having a dollar 100 years from now. So what we say is that there are actually markets that can be informative about this. And in particular, what we're going to do is we're going to be exploiting a feature of housing markets, both in the UK and in Singapore, to allow us to provide direct estimates of these very long-run discount rates. So the specific feature we exploit in this research is that residential property ownership in these countries comes in one of two forms. One of them is a freehold. Freehold is basically the way you own property in the US. It's a permanent ownership contract. But there's also, alongside these freeholds, you also have many leaseholds trading. And leaseholds are temporary ownership contracts with varying amounts of maturity. So it could be anywhere from 100 years to 1,000 years. What's important is that they're prepaid. So you pay money today to own the property for 100 years. There's a very liquid secondary market for leaseholds. They usually exist on very similar properties at the freeholds. And while you own these properties, say, for 100 or 200 or 300 years, there's very few contractual restrictions on the leaseholder. Now, very simple finance theory tells you that when you're trying to compare now the price difference for an otherwise identical property between, say, a 100-year leasehold and a freehold, any price difference that you observe in the market is going to capture the present value today of owning the property in 100 years. Why? Well, both the leasehold and the freehold allow you to own the property for 100 years. And then the freehold allows you to own it beyond that, while the leasehold doesn't. So any price difference has to capture that additional right to own the property in 100 years from now. And almost, by definition, that price difference is therefore informative about the present value of a dollar in 100 years and going forward. And so what we do is we construct a data set of the universe of all property transactions in these countries to estimate how much more are people willing to pay to, say, own a property forever versus owning it for 100 years. And what we find is just summarized in this graph, which captures the discount, the price, the relative price discount of owning it just for 100 years versus owning it forever. And what you can see is that there's a substantial price difference. So a freehold is worth about 15 to 20% more than owning the property just for, say, 90 or 95 years. And that price difference is then consistent with a relatively low discount rate for housing, somewhere in the order of magnitude of about 2.6%. So that gives us what we think is the first private market-driven discount rate that you have over horizons, beyond sort of, a handful of decades, going all the way up to 100 years. The sort of horizons that are really relevant, for some of these climate change mitigation. Now, the question is, should you then use 2.6% as the discount rate for climate change mitigation? And the answer is, well, not immediately. Why? Well, again, we know from simple finance theory that discount rates for a project, any project, are a combination of two objects. One is a risk-free discount rate. That risk-free discount rate is sort of common across all projects. And then there's a risk premium, right? And the risk premium can be positive if an investment is risky. This is, investments that usually just pay off in good states of the world. Why? Well, because in good states of the world, we already have a lot of money, so we don't value that extra payoff so much. So we discount it at a higher rate. That risk premium can actually be negative if the investment is what we call a hedge. So these are investments that pay primarily in bad states of the world. Think about insurance contracts, right? And if an investment pays primarily in bad states of the world, in expectation, it actually is, sometimes delivers a discount rate that's less than the risk-free rate. This is a very simple insight coming from the CAPM, the capital asset pricing model, and a lot of, other finance theory. And so what we observe in the data is we observe a discount rate, the R, which again is a sum of a risk-free rate and a risk premium for housing, which is a risky asset. Now, we don't really know how large the risk premium for housing is, but we know it's positive. Why? Well, because house prices usually rise when the economy is doing well. So what we know is that the 2.6% is the sum of a risk-free rate and a risk premium that's positive. Now, when you think about investing in climate change mitigation, right, you think of that usually as a hedging property. Why? Because climate disasters have the ability to shift the world into very bad, sort of low GDP, low growth states of the world. This is an insight that Marty Weitzman has had and others too. Now, there's a little bit of a disagreement on how to model this. And, I've recently written a review article with Brian Kelly and Stefano Giglio, where we sort of summarize some of this. But climate investments, generally pay off in these bad states of the world because the climate shock, almost by design, pushes you to be one of these bad states of the world. And so therefore, investing in climate change mitigation is a hedge and should have a negative risk premium. What that means is that this 2.6% that we get for housing is actually an upper bound on what the discount rate should be for investing in these hedging climate change mitigation projects. And in fact, it's possible that the discount rates are substantially below this. How far below? Well, you can't say how far below without taking a much stronger stand on a model. Though if you think back to the range of discount rates used in practice, 1% to 7%, having 2.6% as an upper bound is already pretty tight and rules out a large range of discount rates used in practice, and actually, implies pretty substantial valuation for these properties. And so, I have a paper, in the RFS coming out this year where, we go through some of this logic in much, much more detail. We take some stance on these sort of modeling disagreements, but, the high level intuition is what you see on this slide here. So again, we think that understanding what the right discount rates are for these investments is really central for governments, policymakers to figure out how much to invest in these projects today. And everything we've seen, everything we've learned from this project is that the long run discount rates that we should use for these climate change mitigation projects are very low. 2.6% really is an upper bound. We're probably thinking about the range 1.5%, 2%. And that therefore these investments are very valuable and society should spend a lot of money today. Again, think about this as paying an insurance premium that really pays off in very bad states of the world, in these climate disaster states of the world. And just like other insurances, this is very valuable and we should invest. Thank you very much for your time. And if you're more interested, the references in the slides can point you to sort of the relevant research papers where we discuss and explore these implications in more detail. Thank you.